I plan to take about 20 minutes or so to explain what the standard is about. If you have questions, I'd ask you to submit them on the GoToMeeting box. You can write them in and we'll get to all of them at the end. I expect my presentation will go about 20 minutes, so we'll have plenty of time for questions and answers. We already have some questions that have come in, so I invite them. Again, want you to understand what I'm talking about today so you can get with your own advisor and have them help you apply it to your own business. So let's get started. Okay, let's get started by first of all talking about what is the new standard and what am I really talking about here. First of all, in June, the American Institute of CPAs passed a new credit loss measurement standard that applies to all financial instruments. I did not say financial institutions. I said all financial instruments. That means all loans, all receivables, all leases, all installment contracts, all securitized assets, and other assets as well. This is a very, very sweeping standard that applies to virtually any business that you're in that has receivables. So it affects all of us, not just the automotive industry, but every business, and the banks are busy evaluating how it impacts them right now. It also applies to any instruments that are either on or off balance sheet. So if you're doing leasing and your leases are off balance sheet, it's going to apply to you as well. It must be applied in all financial statements prepared under generally accepted accounting principles. So if you have a banking relationship, you're borrowing money and you have loan covenants and you're required to provide financial statements prepared under generally accepted accounting principles, this is going to apply to you. And you need to understand what the impact is so you can get out ahead of this thing and minimize whatever that impact may be on your business. And what is the change that I'm talking about? What does this mean? Well, first of all, under the current loss recognition methodology, it's called the incurred loss methodology, where you have to provide a reserve for losses in your financial statements when losses are probable. And several years ago, when the AICPA was developing this standard, I was very much in favor of it, and I was an advocate, and along with several of my peers, we were successful in getting incurred loss methodology approved as the standard. And what that meant was that there was a lot of judgment and flexibility in applying this methodology, because there is a number of different ways to determine whether a loss is going to be probable or not, and there's different time periods that may be required depending on how you collect your receivables as to how far you look out to identify these probable losses. So there was a great deal of variance in practice, particularly in the buy here, pay here business, on how to apply this methodology. In some cases, dealers would book a quarter's worth of losses, they would book a half a year's worth of losses, or maybe even a year's worth of losses. But generally, from what I've seen in the industry, very few were providing more than, say, 1 year's worth of net losses as incurred in the prior year. Some made some additional adjustments, but that was typically the approach that they took. Under this new standard, you're going to be required to provide for credit losses that are estimated in the future. So in addition to those losses that are probable, you now have to look out into the future and identify any additional losses which are going to be forthcoming in your portfolios, even if those losses might be remote. Now we're going to talk a little bit about what that means and how you're going to be able to make those estimates, but as you can probably see just by my explanation that this is going to have certainly the effect in many cases of increasing the amount of reserve for bad debts that you have to put in your financial statements. So what is the impact on each individual operator? Well, that's going to vary significantly depending on what your current methodology is. If you're just providing 3 or 6 months worth of net losses, which includes recoveries, by the way, in your financial statements right now, this could have a very significant impact on your financial statements. It could increase your loss reserve significantly. If, on the other hand, you're providing a reserve that contemplates losses over the entire life of your portfolio, then the impact probably won't be as great. So it depends on what you're doing currently, and it also depends on the growth in your portfolio, because any new paper that you put on, you're going to have to provide more of a loss reserve than paper that's already seasoned, because it will have already incurred some of its losses. Now, the bad news is that any increase in the reserve for bad debts brings about a corresponding reduction in your equity. So if you have loan covenants that require a minimum net worth, or if your bank is looking hard at how much equity you have in your business, and you have equity today, after you apply this new accounting standard, that's going to change. So you are going to have to know what that change is going to be and deal with that accordingly as you move forward proactively. And the worst news of all is, as is the case right now with reserve for bad debts, any increase in your loss reserve or your loss reserve in general is not deductible for federal income tax purposes. So this is going to be a financial statement adjustment which does not generate a tax deduction for you. Now, if you're a public company, the application of the new standard is required by 2019, but if you're not a public company and you're a private company, the requirement will be in 2020, and some of you may be saying, well, geez, Ken, that's several years off. What are you bothering us about it right now? We're busy getting ready for the selling season. Well, the reason is the banks are looking at it right now, and the chances are that after they get done looking at it, if they have to increase their reserves, that decreases their capital, which decreases their lending abilities. And therefore, they're going to turn right back around and look at all their customer relationships and determine who's going to be affected the most. So if they come to you and talk about restructuring your covenants or rethinking the loan, you need to be prepared to be able to deal with this and talk with them, because you don't want to change your borrowing relationship. So the reality is you need to get out ahead of this thing. You need to be proactive in determining what the effect is and getting with your banker, and also getting determining how you're going to deal with this in your financial statements. For instance, are you going to wait to 2020 and let your equity go down if it's significant? Of course not. What you want to do is start dealing with it now and come up with a solution that's going to minimize the impact on your business and minimize the impact with your borrowing relationships. So why I'm bringing this issue to your attention now is the concern that you need to have enough time to make the right decision and to minimize the impact of this new standard in your own business. So what should you do now? These are my suggestions. Number one, after this webinar, I would consult with my CPA or financial advisor and ask them to explain this new bulletin to you. If they're not familiar with it, or they're not sure of what you're talking about, you need to encourage them to do that, and you need to seek additional resources, because I can promise you this, that if they don't understand how to help you apply it and you don't understand how to apply it, you're going to get the worst answer possible. So the reality is it's incumbent upon you and your financial people to minimize the impact of this in your own company. And to do that, you're going to have to calculate what that impact is going to be and figure out which way is the best way to have the least detrimental impact on your financials. I can tell you that while there's not one prescribed methodology for applying the new bulletin, it's clear that the use of metrics is probably going to be the best way, in my opinion, to apply it to a buy here, pay here operation. And what I mean by metrics, you're going to have to know what static pool is, you're going to have to know what loss liquidation calculations are, you're going to have to know what default rates are, and you're going to have to be able to identify, based on your outstanding receivables, what the remaining losses are going to be based on historical information. You're not required to do forward-looking projections. You're supposed to be using your historical information as one of the primary indicators of what to provide under this new loss reserve methodology. I think the other thing is that you have to identify any changes in current economic conditions that also need to be considered, like, for instance, looking at your aging or looking at any changes in your business model, which might also have an impact. But it's safe to say that because you'll be relying on your historical information, it's going to be much less subjective than perhaps it was under the incurred loss methodology that currently exists. Now, after you've determined the impact and talked it over with your CPA and figured out a strategy, you have to understand how that's going to affect your loan covenants and your borrowing relationships. And I encourage you to do that internally before you go to your bank, and so you understand what the answer is going to be and then how you're going to deal with it. In some cases, you may have a indirect finance company that's acquiring charged-off paper, and I want to point out that the accounting treatment for purchasing deteriorated credit receivables is different, and that any loss reserves that are required for that need to be considered in the purchase price adjustment. So it's important that you understand the bulletins and this bulletin and then apply it to whatever the fact situation may be. So where can you learn more about this financial standard? First of all, what I've done today is intended to merely make you aware of the new standard. But what comes next is how to apply it. And that takes a lot more one-on-one and a lot more knowledge than what I'm able to cover in a webinar. So my first thought is that you go to your financial advisor, your CPA now, and start to make the evaluation. You determine what metrics you have that you may be able to use to calculate the impact. If you don't have any metrics, or you don't even know what your net static pool loss rate is, and by the way, it's not what you run out of your DMS system. That's not good enough. That requires a number of adjustments. It's just supposed to give you a general idea of how you're doing, but it's not adequate to make this kind of calculation that's going to impact you. So you then determine what metrics, and if you don't know what these metrics are, you can go on my website at www.subanalytics.com. There's 2 free videos on there that you can look at which explain them, and certainly after you see what's required there, you can start building the necessary information. Now, in the event your CPA does or doesn't know a great deal about this new standard, I want to suggest to you that you send him or your financial person or both to our conference in Orlando on November 1st through the 3rd, because we'll have 4 of the best CPAs in the nation talking about how to apply this thing. One of them is a lender that provides a lot of capital to this business, and he's going to tell you how it's going to affect the relationships with his clients. So you're going to get a view of how to apply this thing and how to handle this thing going forward. And finally, I want to see this challenge being overcome by all of you. And so if your CPA or your financial advisor is unable to get any information that's really needed to handle this calculation, I want you to feel free to have them contact me, no obligation basis. I'll be happy to share any information with them. The other thing I would say is that if your advisors are not familiar, you can order a copy of the bulletin, or your CPA can, from the AICPA, and that information, it should be readily available to any financial advisor. They can order a copy of the standard and then become more familiar with the details. It's quite extensive, and several of the CPA firms have come out with detailed analysis of the standard. One of those is going to be handed out at our show in Orlando, and I've actually seen 2 or 3 very good copies that provide some excellent insights in how to apply this. So I encourage you that the information is starting to flow on the new standard. I'm trying to alert you to it. The AICPA is going to put out some additional information on it, I know. So again, my message is get out ahead of this thing, and you'll be much better off than letting it catch you by surprise or make a significant adjustment when you're not prepared. I want to also say to you, as an incentive to get it right, anyone attending this webinar today is welcome to attend NABD in Orlando for $375, which is close to our cost for attendees. If you've not been to the Rose and Shingle Creek, shame on you, because it's the finest resort in Orlando. It clearly has five-star golf course, spa, many restaurants, beautiful hotel, and we've got $199 room rates with no resort fee. So you'll enjoy the facilities while you're learning at the same time. I'd like now to move into some questions, which I'm sure some of you may have, and some of them have already come in. So Joe, if you will help me take some of these questions, we'll take them one at a time. You've got a couple there already, so let's get started.
Yeah. First question is, why did the AICPA change the credit loss measurement standard?
Well, that's a good question. I think many of you are probably saying, why did they do this to us? I mean, we've already got enough regulatory challenges. What's behind it? Well, first of all, the banks have felt that for some time when they get a financial statement, they're having to make a number of calculations to estimate what the future losses are going to be anyway, to determine how your ability to repay those loans that are collateralized by these receivables. So they were an advocate for changing the loss standards so that they no longer had to make these sidebar type calculations. I think the other feeling is that there have been some concerns about losses that have taken place in the subprime market. Of course, the mortgage fiasco is well chronicled, but we're already seeing some significant losses in some of the auto bond securitizations, not all of them, but some of them. And I think the concern is that we want to provide enough information so investors and third-party users of these financial statements can really understand what the financial position and condition of the company is. So I think the AICPA's view is that this is going to provide more meaningful information to third-party users or readers of the financial statement. That's what's really behind it.
All right, and the next question we have is, why is any increase in the loss reserve not deductible for income tax purposes?
Well, I know that's a hard thing to accept, because anything that's going to negatively affect your financial statements you'd like to get a tax benefit for. But the truth is, for many years, a reserve, since 1989 actually, a loss reserve has not been deductible for federal income tax purposes. So this change in standard does not change any tax treatment. The IRS changed the ability to deduct loss reserves in the late 1980s, And that was the primary reason why we promulgated the use of related finance companies, because it would provide a deduction on some of that paper profit that was being recognized up front. So the RFCs then kind of replaced the older methodology, which was a deduction of reserve for bad debts. But again, I'm not justifying it. It's just that there's always been differences between generally accepted accounting principles and tax accounting, and this is one of them. Unfortunately, it's going to be bigger in the future if your loss reserve increases.
All right, next question we have here is, what if my CPA or financial advisor is not familiar with this new standard? Where can I get help?
Well, I think first of all, you want to encourage your CPA to do some further research and get some assistance in helping understand it, because if he or she is going to be helping you apply it, it's his responsibility to do that. But at the end of the day, you've got to get the best professional advice possible. So you want to encourage your CPA to do his homework and to help you. But if he doesn't, then you're going to have to seek additional resources by some of the conferences that I'm talking about, getting information from the AICPA, networking with other people to protect yourself. I mean, this is serious business, and you don't want your financial relationships with your banks to get terminated or to be adversely affected by not knowing how to apply this standard.
And we have another question somewhat in the same vein. It says, will my banker even know about this, and should I discuss it with him?
Well, I can assure you that most of the bankers do know about this. As a matter of fact, I consult with bankers and capital markets companies every week, and every single one of them that I've talked to is absolutely familiar with this new standard and is already looking at how it's going to impact them. And I can tell you this, that their auditors who will be responsible for issuing the financial statements on these banks are going to be familiar with it, and they're going to make them apply the standards, and you can just assume that then it's going to trickle back down to you. So if your banker's not aware of it, I would be very surprised, but in the event, he probably isn't very connected to what's going on in the auto finance business, because certainly auto receivables are definitely impacted by the new standard.
All right, we've got several questions coming in here. I know we only have time for a couple more. Where do I get more information on the metrics needed to calculate the impact on my equity?
That's a good question, and again, that's your responsibility as a company. Your CPA is not going to be able to help develop information that you don't have. So the first starting point is that I go into your DMS system and see what's available through your DMS system as a starting point. Not as an ending point, but as a starting point. And once you do that, then what I would do is encourage you to go on my SubAnalytics website and look at those free videos so you can at least understand how these calculations should be made. When you've done those two things, then I think you get with your internal financial people and your external financial people and talk about how you're going to get this information as accurate as possible to apply it. And that's going to require some discussion, some meetings, and things of that nature. Now, if you're at that point and you're not certain that you're getting the right approach, feel free to give me a call. Feel free to to also network with other peers who are applying and see what they're doing, so that you can at least understand what's going to be needed. But I think it's important to start now, because some of you just don't have any historical information to apply this thing. So you're going to have to get busy developing it.
All right, next question is, what is the AICPA bulletin this refers to?
Okay, this happens to be, again, new credit loss measurement standards, ASC 326. So all you'll have to do is contact the AICPA, or have your CPA contact the AICPA and ask them for the new credit loss measurement standard from June 2016, ASC 326.
All right, next question, two parts here. What is the rationale for requiring all future losses to be reserved for, and doesn't this go beyond the going concern principle of accounting?
That's a great question, and I've had a number of dealers call me and talk to me about that, and they said, Ken, well, you know, it seems like we're recognizing future losses, but we haven't had the benefit of recognizing future earnings to offset them. And while that doesn't seem to be a good matching, I think it's the view of the AICPA that if you're not providing for historical, if you're not providing for future losses based on your historical performance, that you really don't have any equity anyway. In other words, if you're booking equity today, but you know that the receivable that's used to calculate your equity is overstated, then don't you have an obligation to a third-party user to make that adjustment? That's what their feeling is. That's what their feeling is. And I think the other feeling is that there's been such a diversity of practice in applying the current standards that there's been a huge variance in how these reserves are being reported and measured. And I think they want to see more standardization in the approach going forward. In talking to a couple dealers, while they feel that the impact may be harsh, many, after they thought about it, say, well, maybe it is fair to have to reduce your receivables for losses that are inherent in those originations. And I think the other thing we have to remember, this isn't a one-time calculation. It isn't like you go in and make the calculation today and you're done with it. Anytime you book a receivable in the future, you're going to have to provide for future losses when you book that receivable. So inherently, you're going to have to deal with this thing on an ongoing basis. I refer to it as the gift that keeps on giving.
All right, and the next question is, won't banks just adjust covenants higher to account for any changes in the financial statements that are simply made to conform with GAAP rather than an actual change in actual business operations?
Well, that's a great question, and of course every bank is going to deal with it separately, and they're going to deal with it on a customer-by-customer basis. I'm sure that banks don't want to certainly run off all their good customers, so I suspect that they're going to try to work with their customers to find an answer that's workable for both sides. But my concern is, having just been to Washington, is the regulators are looking closely at these banking relationships, and they are going to question why loans are being made on a significant basis to customers that have no equity in their business. And so clearly, I think we have to be cognizant of the fact that the consumer advocates are looking for ways to shortcut or to short the amount of capital that's flowing into our industry. So we've got to take a proactive approach to show that we're strong enough to be able to repay those loans. So again, I think you're going to have to work with your own banker to figure out what the impact's going to be. They're not going to run off all the good customers, and they're not going to stop lending to this business. I'm not saying that at all, but you're going to have some good answers for them, and you can't just expect that they're going to restructure the covenants and make it all well.
All right. Next question is, where do I get more information on the metrics needed to calculate the impact on my equity?
Well, I think that's going to be the subject of what we're going to discuss in Orlando, and I think that's best left to practitioners who are going to be helping you apply the standards, to bankers that are going to have to interpret what the impact is going to be. And I think it's too difficult to do that over a webinar like this. I think that's something that is going to have to start with one-on-one consultations with your own advisor, but then I think you're going to have to seek some additional opinions like I'm talking about. So I'm not avoiding the question, but it's because of the impact is going to vary between different companies. You can't give you a general answer. There's certainly some methodologies that we can suggest, but I'd rather have you start to look at your own situation first.
All right, and then we're having people ask how they can obtain the slides of the presentation.
Well, we'll be happy. Anyone who would like to email me or Joe, you can email me, Ken, K-E-N, at kenshilson.com, and I'll make sure we send you copies of the slides, or they can email you, Joe at kenshilson.com.
Correct.
And you'll email it to them as well. So we're happy to provide a copy of the slides that's going to help you. Joe, I want to cover a couple more questions that I've had because I think it's important. Some of you are saying, oh, Ken, fortunately this isn't going to impact us at all because, you know, we have a related finance company. You help us set it up. And remember, we already have a discount recorded on our financial statements, so that should be more than adequate to take care of the loss reserve. That's not correct. And here's why. If you're doing a combined financial statement for your bank and you're combining your sales company with your related finance company, that discount and the discount deduction in your sales company is eliminated in consolidation. So it won't even exist. It won't be there to be able to offset or to be able to take the place of a loss reserve. So it's only if your reporting requirement with your bank is just for your related finance company and doesn't include your sales company that you may be able to argue and shift some of the discount that you've recorded on the purchase of contracts from your sales company into whatever the loss reserve requirement may be. So again, this is one of the complexities that you're going to have to deal with as you sit down with your financial advisor and then subsequently with your banker to see, you know, how you work through this thing. But there's a myriad of ways that this can be applied, and it's going to be interesting to see how much homework you do to try to get the best answer possible. Other questions, Joe? Okay, very good. Well, I think that we've covered everything that I wanted to cover today, and again, I want to encourage you to seek additional information. I appreciate all of you in joining us today. I hope that this will not have an adverse impact in your business. I really do, and I hope that 2017 will be your best year ever. But in order to make that happen, you're going to have to deal with this new standard as well as a number of other new developments in the industry, which we'll cover in Orlando. So God bless all of you. Thanks for joining us today. Thanks for your questions, and I hope to see many of you in Orlando. Thank you.